Good morning or good afternoon, and welcome to our webinar, A Fresh Look at Community Bank Capital. My name is Jeff Rigsby, and I'm President and CEO of CB Resource, and I'll be today's webinar's host and also shortly be introducing our guest speaker. First, I do want to take this opportunity to thank you for taking time out of your busy schedule and joining us today. We do recognize how busy you all are, and we are committed to sticking to our scheduled time. For those of you that are not familiar with Finance 500 or CB Resource, just a quick overview there. Finance 500 is a full-service broker-dealer with over 2,000 community bank clients across the country. The company's been serving community banks for over 20 years, and CB Resource is a performance management company that focuses on providing community banks across the country with enterprise risk management, capital planning, and strategic planning solutions. Combined, the companies share common ownership and really seek to bring these two disciplines together to take care of both the capital markets, fixed income, and performance management needs of our clients. So with that, I do want to take this opportunity to introduce our guest speaker today. Chris Hogg is the head of investment banking for Finance 500. Chris has over 30 years experience in the investment banking business. He retired from Goldman Sachs after 24 plus years of dedicated service. During that time, Chris was also responsible for the inventor, the creator of Trust Preferred, and something he can hang his hat on. But in short, Chris is an innovative leader in the investment banking field, and we're very fortunate to have him with us today to talk about the ins and outs of issuing debt. Just before I invite Chris to get started, I do want to just a couple housekeeping things on the webinar. You do have the opportunity to ask questions vis-a-vis the GoToMeeting function. Just feel free to click on that and you can do so. The presentation is also available upon request, as is the recorded version. So feel free to send us an email, give us a call, and we'll make sure you get either or both. Now, without further ado, I'd like to introduce our special guest speaker today, Christopher Hogg.
Jeff, thank you very much, and thank you everybody for joining. We really appreciate it. We thought that we'd try and take a fresh look at community bank capital, and in doing so, address the 10 questions you have in front of you now. I kind of grouped question 1 and question 6 together. It seems like most every community bank is issuing right now. If you look at the volume of issuance, that would certainly seem to be the case. So a legitimate question is, am I missing something if you're not issuing? But the other side of the coin is, it also seems that a significant number of community banks are buying that bank capital. Should I be doing so? What makes sense? What doesn't? Here are the other questions. Number 2, why issue capital? What are the purposes for doing so? Then how much capital do I need? Both Jeff and I will address that. What should I do with the proceeds in the immediate term? How should I structure the deal? Question 5. Jumping to number 7. How should I look at the market? I get multiple emails, and I'm sure you all do, saying I have to issue now. Do I have to issue now? Should I have a capital plan? How does it tie into enterprise risk management? Of course, a topic dear to Jeff's heart. Then if I do decide to issue, how should I do so? And finally, what do the regulators think about all of this, both on the issuance side and on the investment side? So let's move ahead now to slide 5, page 5 rather. So 5 key points I want to make sure that you take away with you today. The first is, we think that the answer about should I issue now is actually presumptively yes. We are right now on the perfect storm of probably the best market for fixed income capital for community banks that I have seen during my entire career. Right now, community banks are able to achieve rates that are at or below 4%. That has never before been achievable. And that's in the context of where equity valuations for community banks are somewhat challenged. So debt really is the best capital markets alternative. Also, and a really important point here, market access for banks of 500 million or less in assets is very real and on very attractive terms. 5 years ago, forget that. It would not have been possible. It is now. There's strong demand actually across all 3 of the key investor bases, all the way down to the smallest of banks. insurers, money managers, but especially other banks. Other community banks are really driving the market right now. I call that phenomenon cooperative capital, with banks both issuing and investing in bank capital. Many of them, in fact, seeing that product as a source of loan substitution and geographic distribution. And actually, that's particularly the case for banks less than $3 billion in assets. Product choice, number 3. The market is not just 10 non-call 5 fixed to float subordinated debt. Senior debt is actually a possibility, and we'll discuss that. There are new opportunities in terms of deploying the cash that you raised in capital, which we'll discuss. And finally, the regulatory environment is benign/favorable in terms of both issuance and investment. So let's move forward now and dig in. Reasons for issuance, question number 2, really both offensive and defensive. On the offensive side, taking advantage of currently historically low rates and market access. Replacing existing high coupon capital, share repurchase, growth possibilities, whether that be buying another bank, buying branches, or other assets. One important point is getting out of restrictive holdco loans. These are transactions which community banks have issued for some time historically, but those transactions done at the holdco level generally have covenants, the pledging of stock, rate step-ups, and other disadvantageous features that are not present in the capital markets instruments. Defensive, preemptive issuance should the market deteriorate. We're not saying it's going to, but given the history of the market, probably not anything other than a sensible point to think about market access as a point. Preemptive issuance, should your market sector or deteriorate in any way, or should COVID-19 come back to us in any way? That's certainly been something that issuers have been thinking about. Equity valuation point I made earlier. And finally, of course, anticipating regulatory requirements in the future. So moving on now, let's look at the regulatory capital levels. Jeff is going to kick us off on this topic.
Great. Thank you, Chris. Just a couple of quick observations as it relates to capital. We're all familiar with the capital requirements we have at the bank, and for many of you at the holding company level, or if you're a Fed member bank. A couple of points I just want to just reinforce if people aren't already familiar with this. You know, we fully phased into Basel III minimum plus buffer back in 2019, but we still have this terminology out there called well-capitalized, or PCA well-capitalized. And even in some cases, some of our board members still kind of hold to this well-capitalized terminology. What's unique, or what's different about where we sit today, is you could be well-capitalized. And if you take a look at the second line on the chart, where if you go out to the far right, where 10% equal to or greater than 10% is well-capitalized, well, Basel III minimum plus buffer is 10.5. So you could be accurate in saying you're well-capitalized, but still be deprived of paying dividends or bonuses if you're below the Basel III minimum plus buffer. So I just want to point out, though we may use terminology like well-capitalized, please make sure you're aligning it with the Basel III minimum plus buffer. Just a couple of other quick points. If you've opted into the community bank leverage ratio or the CBLR alternative, that's great. Your minimum capital level is 9%, and you don't really carry the burden of worrying about common equity tier 1 risk-based, or total risk-based. Bear in mind, remember, if you ever feel you want to press the gas a little more, and that 9% is a threshold you're not particularly crazy about, you can always opt out. And my last comment is talking about bank holding company debt, and this is particularly for those of you Fed member banks. The Fed does examine, when you're looking at any kind of capital issuance or your capital position, they do test the bank holding company double leverage ratio. And if it's about 100%, you're fine. And we can get into this offline at some point in time. But if you start creeping up there around 125% ratio from a double leverage standpoint, it is something they tend to scrutinize. So thank you, Chris. Back to you.
Thank you, Jeff. I just had a couple of very quick points on the right-hand side there, which is on capital mix. One is this point about preponderance of a bank's capital. That is the regulatory standard for how much equity you need to have in terms of your capital mix. That's been interpreted as meaning a majority of your capital. So that gives a fair bit of room for fixed income capital products. We're seeing now, with trust preferred becoming some time ago a thing of the past, that regulators are now much more comfortable with the subordinated debt product, and indeed the Small Bank Holding Company Act senior debt product. And so that's actually a helpful thing in terms of how strong the capital markets are right now. Turning now to the next page, just quickly, want to make the point that as the market has grown, that actually has created greater liquidity. That's fairly relevant for those of you as issuers who actually choose to invest in other bank capital. We see many banks actually booking their bank capital investments as loans. There's favorable treatment in that regard. Most importantly, probably no mark to market on those investments. And the loan market itself has grown and has become more liquid. So that instrument has become quite a liquid source of investment. We're also seeing, and we'll be doing other presentations on this, new sources of leverage in terms of CD issuance and so on in terms of investment. And finally, there's now a broader range of instruments out there. Just a few examples we've cited that you can use for the initial investment of the proceeds of any capital transaction you may choose to do. So moving on from there, let's talk a little bit about structuring your transaction. I've alluded now a couple of times to senior debt as an alternative, and I do want to talk about that a little bit now. The question down the bottom, the answer is not subordinated debt. What's the question? Really, the question is, what is right for you, the issuer? So turning to the right-hand side of this page, talking about senior debt issued under the Small Bank Holding Company Act. There is, in fact, an exemption under the Small Bank Holding Company Act, which permits banks with assets of size of less than $3 billion to issue holdco senior debt, downstream the proceeds as equity, and gain Tier 1 capital treatment without any negative regulatory impact. The regulators intended this to be something of a reverse trust preferred to replace trust preferred. It is potentially cheaper than subordinated debt. It has no capital amortization. And it also has some degree of structural flexibility in the sense that we can actually embed in it potentially real call options, for example, a 5 non-call 3 type structure. But also there's a good range of flexibility too with respect to subordinated debt. Of course, the vast majority of issuance has been the 10 non-call 5 fixed to float structure. Why is it structured that way? To avoid Tier 2 capital amortization on the instrument. The regulatory provisions are that subordinated debt amortizes as capital 20% a year once it's within 5 years of its legal maturity. Hence the 10 non-call 5, with that 5-year call functioning as something of a synthetic maturity. We can actually expand, however, the maturity of subordinated debt with 12 non-call 7s or 15 non-call 10s. And that's worth thinking about in a market environment that's as attractive as the one that we're in now. All these things worth considering well prior to actual issuance. And that's something we very much focus on in our dialogue with issuers. So moving on now, let's talk a little bit about cooperative capital, my term. One of the important backgrounds to the market right now is that we're seeing community banks both issue and invest. And that's really driven a tremendous amount of the increase in market volume, both in primary issuance and in secondary market trading. So look at what some of the issuers have been thinking about. It's the lowest cost source of capital, certainly true. It's non-dilutive, it's deductible. We've already talked about the dynamics in the market. It's unsecured, virtually free of covenants, no stock pledge required. That's essentially fixed rate, and it certainly has no credit-related rate adjustment, unlike holdco loans. On the right-hand side, why invest? Well, it's potentially the highest yielding asset in your community bank portfolio. It can be seen as a loan supplemental replacement, and indeed, the investment may be booked as a loan, with one of the key advantages being no mark to market and somewhat reduced portfolio restrictions. Other advantages, it's an investment in a familiar industry. And on the other hand, it actually provides the potential of geographic portfolio diversification outside the investment bank's MSA. Moving on now to the next page, just a little bit about the regulatory environment here, particularly for banks that have less than $3 billion in assets. In fact, one of the other benefits of the Small Bank Holding Company Act, on top of the exemption for senior debt that I mentioned earlier, is that there is some degree of regulatory flexibility in terms of investment in terms of the regulations that the Fed has provided for investing in instruments. And that's actually also helpful in terms of building the market up. Again, focusing on smaller, less than 3 billion banks rather than larger ones. Moving on now, let's talk about the market, which we'll be doing in the next 3 slides. So the first point goes to all those emails that you've been receiving about how active the market is and how receptive the market is. Well, they're right. Take a look at what happened in 2020. A terrible year for the world with the advent of COVID, but actually an excellent year for capital markets for community banks. Just a massive upsurge in issuance in terms of both volume and the number of transactions. And that was caused by a number of factors, at least in our opinion. One, on the right-hand side, how we see yields, underlying treasury yields certainly, but overall yields for these transactions trending in a very, very attractive direction from an issuance point of view. We saw continued strong demand from all 3, and continue to see this, investor bases that focus on community banks. Other community banks certainly, but also insurance companies and money managers are very focused on this sector and are eager to buy more issuance as it becomes available. One other key thing, and let's go to the next slide to discuss it, is that banks with 500 million or less in assets absolutely have market access right now. Really, that's a point that I want to stress. 3-4 years ago, that was not the case. Even a couple of years ago, that was not the case. Now, smaller banks absolutely have market access. They have market access in smaller transactions. 5 million or less in size may be issued, and they will enjoy similar rates to those of some of their larger brethren. So that's just a really significant, really revolutionary development that's occurred really quite recently, which should be taken quite seriously from an opportunity perspective by smaller banks. Turn to the next page now. Another interesting thing has happened in the market, and that is that it has become a much more open market in terms of the broker-dealer participants. Used to be that the market was dominated by 2 or 3 houses focused in the area, and there's still certainly participants, but now we see a much broader range of issuance of participants. That we think is a very great positive for issuers, because the brokers who are bringing these transactions must presumably know the issuers that they represent better. And that we think is one key theme that has emerged in a market this crowded. That is the need to tell the issuer's credit story effectively so as to distinguish issuers from the others who are coming to the market. So we think that's a positive development, both from the perspective of an issuer and from an investor. Higher quality distribution. That's enough on the market now. Let's talk a little bit about the participants. So I mentioned that there are 3 participants. Banks, yes, do indeed make up the most important part of the investor base right now, but make no mistake about it, insurance companies have historically been and will continue to be major participants in the market, as will money managers. Generally speaking, we've found that for transactions less than 15 million in size, banks have made up the largest component of the purchaser base. And that's significant because for transactions that move more into the 15 million plus size, we generally encourage issuers to obtain credit ratings. Make no mistake, you banks who have less than 500 million in assets, you can expect, properly handled, to obtain an investment grade rating from a suitable rating agency, and we'll be touching on that. So there's a size break if you like, but again, make no mistake, all 3 of these investor bases are very, very focused on buying more community bank debt right now. So moving on. Jeff, I think you're going to take the next couple of slides, sir.
Yeah, thank you, Chris. You know, as you evaluate your strategic alternatives as it relates to capital, it is important that you adopt some form of discipline to not just evaluate the alternatives, but also communicate the alternatives. So what we're really doing here is just framing a simple approach to saying, you know, what are the alternatives that we often consider? What are the right questions to ask? And how do we form this in such a way that would be viewed as good critical thinking and things that would support any type of communication, be it with our boards with your regulators or even with your investors. So really what we're looking at here is a mechanism or a framework, if you will, to answer the question, what am I looking to do? And there's some common questions you want to be able to answer. So whether you're looking at things like growth opportunities or paying down some expensive sub debt, or perhaps a stock repurchase, or altering your dividend policy, or even something on a bigger level like a merger and acquisition type of scenario, is what are the questions we need to ask? And in all cases, it's always, what's the impact to capital? And that might just be something as simple as, what's my base case? What am I looking at? Or the next question, if I want to do a buyback, can I fund that through existing capital, or is additional capital necessary? Or if I want to look at a buyback plus dividends, but you can kind of see a stream of data follow. What are my assumptions? What's the impact to capital? And what are the key levers, right? And does it ultimately impact my book value and market value equity? So I wanted to just illustrate a simple format that allows you to summarize your assumptions and look at the nature of the impact to capital based on these various alternatives. The second piece is what really goes into a full capital plan, and that's a little different, right? So what we want to incorporate, or when you talk about using a capital plan for something like this, it's great to frame your alternatives, but more importantly, it's also, for lack of a better term, best practice to address 3 or 4 different things. Number one is just you want a plan that can specifically articulate your capital adequacy as it relates to your strategy, number one. Number two, the fact that you can incorporate or develop a simple mechanism to articulate what your bank's risk profile is. And it should be based on some sort of fact-based assessment. Now, these 2 examples you see to the right of the bullet points is just, are we looking at the impact of capital from more than one scenario? In this case, it's asking the question, okay, what's our base case? Let's run it as an adverse case, a severely adverse case. And how does that stack up to whether it's looking at PCA well capitalized for tier 1 leverage or Basel III minimum plus buffer for something like total capital, or what used to be known as total risk-based capital. But in any case, your capital plan should articulate what your intent is, what the impact is in good times and bad. And if you really think about it, it's also a great introduction to set up a framework for good risk management and something that can support migrating into an ERM process. Chris, back to you.
Thank you, sir. Now let's talk about issuance. How difficult is it? Actually, the question is, how easy is it? Fortunately, as the markets have become more transparent, more active, we've seen really a standardized issuance process being adopted by all the participants. Almost all of these transactions are Regulation D 144A deals. Those are transactions that are privately placed, but that are governed by the federal securities laws and are really now subject to pretty standard issuance procedures, pretty standard documentation from the legal point of view have emerged, and the method I'm about to describe to you in terms of issuance is also really broadly accepted across the market. 3 phases of execution. First, preparation. Of course, it starts with due diligence, something we take very seriously indeed. When we do due diligence, we do it in conjunction with preparing the IP, the investor presentation. This is the document, the primary document that's used to market your transaction. It's prepared only from public information. It's very definitely prepared to conform with your website so that it's a really effective marketing document, not just for the individual transaction, but also for positioning your bank generally. We actually have 2 phases of marketing. One is with what we call a teaser, which is a 1 to 2 page document describing the issuing bank, but not identifying it. It's intended to bring people into the transaction when we start marketing. And then, of course, the IP itself. So one decision that needs to be made, of course, at the preparation stage is what type of product you're going to do, senior or subordinated, 10 non-call 5, 12 non-call 7, the points I raised earlier about product selection. That needs to be done up front. Also, what needs to be done up front is to decide about credit rating, should you get one. Generally, as I mentioned, for transactions more than 15 million, credit ratings are appropriate because insurance companies need them. More on that in a moment. There are really 2 rating agencies that you should be thinking about. One is Kroll Bond Ratings, and the other is Egan-Jones. I'll get dig into those a little more with you in a few moments, but generally Egan-Jones is more appropriate for banks that have asset size of $1 billion or less. You should expect about a week for actual marketing. We use NDAs, non-disclosure agreements, to protect your confidentiality in a very disciplined distribution process. It will be transparent to you as an issuer, so you know at all stages what to expect. Key point, you basically owe nothing unless and until the transaction is closed. We've worked very hard to minimize legal and other expenses and to simplify the documents as much as possible, or to your benefit in terms of how much it actually costs for you to raise that capital. Okay, moving on. Just go back one slide, please. So rating agencies. Kroll and Egan-Jones, as I mentioned, are the two key rating agencies for community banks. Kroll really is mostly suited for banks of really $3 billion or more in assets, but they certainly rate banks smaller than that. And they really are the leading agency in the sector without question, and they're an excellent rating agency. So is Egan-Jones. Egan-Jones, however, focuses on smaller financial issuers, and so they're ideal for banks that have really $1 billion or less in terms of assets. Banks of $500 million or less in terms of assets, you absolutely, if you're a well-run bank, you absolutely can expect to receive an investment grade rating from Egan-Jones. But don't take my word for it. Both rating agencies have a very streamlined procedure for determining your rating. Really just takes a week or so to do so. It's completely confidential. No obligation to take the rating if you decide not to do so, and you only have to pay for it when you actually use it when you close your transaction. Moving to the next page, just a little bit about why ratings are important. And simply stated, it's because insurance companies really won't buy without them. The battle of acronyms, as I put it up here. The National Association of Insurance Commissioners, which is the regulatory body for insurance companies, actually imposes, in the chart below there, the capital that insurance companies are required to hold against the investments they make. If you have a credit rating from an NRSRO, a nationally recognized statistical rating organization, that means a rating agency recognized as such by the SEC, then you can see highlighted in light blue there that it makes a big difference if we can come with a transaction with an investment grade rating to them. And again, you can expect that properly handled if you are a well-managed bank, even if you have assets below 500 million in size. So moving on now, let's just talk a little bit about the regulatory environment. I would describe the regulatory environment as helpful and positive, both on the issuance side and the investment side. Don't get me wrong, the regulators are going to continue to be very careful and so forth in terms of capital levels, structure, and so forth. But the concept of cooperative capital is one they understand and have been helpful in terms of implementing. And it's been an important background for building the market for access to capital for community banks to the very favorable level it is in right now. So now I'm going to wrap up my comments at this stage on the next slide, just by coming back to those 5 takeaways I mentioned at the outset, just very quickly. We actually do think that now is an excellent time to issue, and it's particularly an excellent time to issue for smaller banks, banks less than 500 million in size. The concept of cooperative capital, other banks investing in banks' capital has certainly proved to be an important one. Doesn't mean, though, that the other 2 investment bases aren't still very, very important. They are. Product selection, point 3, not just subordinated debt, but also senior debt for banks with less than $3 billion in assets. And there are certain other structural features that will be considered before you actually issue. The emergence, 4th point, of new ways of investing the proceeds, we've already discussed, and again, we intend to come back to you on. And finally, again, a favorable environment, a positive environment in terms of both issuance and investment. So thank you for listening. I'm now going to turn this back to Jeff.
Great. Thanks, Chris. Hey, I'm going to go ahead and tee us up for some questions and answers now. And just for any of you that have a question or answer while you're formulating your questions, just another quick word. You know, there's a standing joke that, you know, there's no such thing as a free lunch. And we thank you all for joining us. Just a quick word while you formulate your questions. Finance 500 and CB Resource have joined forces under common ownership to really be innovators in both the full service of a broker-dealer, including fixed income products and investment banking, much of what Chris is covering today, as well as the professional service solutions in the areas of risk management and business and performance management. So with that, we just want to let you know, as we get close to concluding today, when you start considering capital, when you start considering the planning and the risk management that goes into optimal performance, we just want you to know we're one of the full service broker dealers that just doesn't handle the transaction, but is a partner with you in forming innovative solutions that leverage all of our capabilities in supporting your needs. So with that said, I do have questions coming through, Chris, so let's go to those. Number one, how long do you think the community capital markets will remain open, especially for smaller banks? And a little subpart to that, and are you concerned that rates might start moving up?
Thanks for that question. I believe that the capital markets for community banks are actually going to remain open for the foreseeable future. And in fact, I expect that we will see another 2020 in 2021. Things are certainly shaping up that way. Yes, there is some concern in the background about the prospect inflation of rates moving up, and they might do so. But importantly, market access still very much seems to be there. So the market, we expect, will continue to be robust and will continue to be open for a broad range of community bank issuers.
Right. Thanks, Chris. Here's another question. So why haven't more banks, or I'm sorry, let me read this correctly. Why haven't I seen more senior debt under the Small Bank Holding Company Act issuances announced or public? So I guess the question is, why haven't I heard more about senior debt before?
Yeah, great question. And it's interesting in talking about the senior debt product with regulators, they've actually said that they feel that it's kind of the best kept secret in Washington, and have quite often said we would like to see smaller banks less than $3 billion, take advantage of it more than they do. All of that said, it is one tool in the tool chest. It's not to say that subordinated debt isn't an excellent product. Of course, it's an excellent product. Again, the key is to design the right product for the individual issuer, so that the answer is subordinated debt. Now, what's the question? Should not be the approach. The approach should be what's right for you. We expect in our dialogue with issuers, we're increasingly seeing issuers look with interest on the senior debt product. We expect to see more of that instrument because it's your best shot at getting the lowest possible coupon.
Great. Here's another one, Chris. So please talk more about ratings. When do you need them? Can a bank less than 500 million in assets really expect to get an investment grade rating?
Again, thank you for that question. Yes, we are really a bank of less than 500 million, of well less than 500 million in assets. If it's a well-managed bank, can expect to get an investment grade rating. Egan-Jones in particular is focused on quality far more than it is on quantity. It's flexible in the way that it will look at ratings for smaller financial institutions. It very much focuses on the quality of management, the longevity of management, longevity of ownership of the bank, clear and well-executed business plan. You got those, even if you're small, you can have a degree of confidence about being able to get a rating. And so when should you consider a rating? Really, when you're looking to do a transaction of 15 million or more in size is when that becomes important, because that's when you want insurance companies involved. And frankly, having insurance companies involved in your capital issuance is a huge positive. They are investors who can take quite sizable chunks of what you issue, and they're also very open to repeat issuance. So having them in your lineup of investors, along with money managers, I might add, is quite a positive.
Okay. Is there a minimum capital level? Are investors interested in offerings that are under 2 to 3 million?
Another great question. The answer is yes. We can do transactions as small as $1 million in size. A couple of years ago, I would have said, look, you shouldn't really do less than 10 million in size because of the legal cost of putting it together. We've now streamlined the legal cost and documentation to an extent that really smaller transactions are perfectly viable. So we could do deals where appropriate down to as small as $1 million in size. Those can be done really quite easily, and you should not expect there to be a pricing impact on those smaller transactions. In fact, I'll bet you that the investors that you go to with those smaller transactions will be saying to you, hey, please come back when you need more.
Great, great. Couple more here. We have started investing in sub-debt, and we're told we could not book the investment as a loan. You mentioned in your presentation it could be booked as a loan. Please expand.
Be happy to do so. Of course, the decision about whether a debt transaction issued in the capital markets is booked as a loan or booked as a bond or security will be dependent upon the individual bank itself and your advisors. Certainly the advice that we've received from our legal advisors, and we've structured our documents accordingly, is that we can have the flexibility for our investors to choose whether to take the instrument in loan format or in bond format, really just by checking a box. And we've found that banks have tended to prefer to take in loan format, where insurance companies and money managers have tended to prefer to take in bond format. We think that the reasons that banks like to take in loan format is, of course, the mark-to-market point, and also the fact that portfolio restrictions, or with respect to banks less than $3 billion in size, are somewhat relaxed. Don't want to overstate that, but they are still somewhat relaxed for those smaller banks. So that would be our observations about how that works, Jeff.
Great, great. Two more here, Chris. One is this senior debt assumable?
Yes, sir. Just like subordinated debt, it is assumable. And let me be clear what I mean by that, just so we're all straight on that. I take this to mean that if a bank issues either senior or subordinated debt and then it sells itself, will that debt survive the transaction, and will the debt be assumed by the new owning entity? And the answer is yes, it will be.
Great. Okay, last one, I think, unless somebody trickles one more in here while we're going, is can we limit who sees our offering? Or I guess can we control who gets to look at it and who doesn't?
Great question. And the answer to that is yes. Now, we have found that local investor interest has been a not unimportant aspect of distributing community bank transactions. And so there can be an advantage to that. But we've also had issuers say, look, I'd really rather not sell my transaction to local banks or to certain local banks or even other banks or investors out there for whatever reason it may be. Here's the key point I want to emphasize, and maybe appropriate if this is the last question. This is your transaction. You get to say, the market is transparent, and we pledge to you, if we're working with you, that we'll be fully transparent to you in all aspects of the transaction, and that includes distribution. So you will get to say whose hands your transaction gets placed in. Absolutely. That's my answer to that question, Jeff.
Very good. Well, I'll tell you what, Chris, I think that concludes the question and answer period for this presentation. I do just want to bring it back and thank all of you for taking time out of your busy schedule. Chris, thank you for your wonderful insights and mastery of the topic. For those of you who want to learn more, you do again have access to this deck. You can also get this presentation digitally or recorded. And just want to point out some contact information here. Chris's contact information is embedded in the presentation. I also know he's been quietly monitoring this presentation, but Robert Finch is the Director of Sales and Marketing at CB Resource and is a great point of contact to learn more about how either Finance 500 or CB Resource can provide greater support for you in both capital opportunities as well as just business performance and risk management. So on behalf of Finance 500 and CB Resource, I want to thank all of you for joining us for today's session. We hope you got a lot out of it, and we hope to see you again at our next session real soon. Thank you.